Good afternoon and welcome to the Calgary Business Podcast. I'm your host, Alan Wazny, and for episode number 357, I've got Justin Fox joining me in the studio. Justin, you introduce yourself and we'll go from there.
Is it Heinz 357?
Heinz 357? Is that the company
Heinz,
you work for?
No. It's Heinz 57, not 357. Anyways, cool. Thanks, Alan, for having me on the show. Sorry, the question was, who do I work with? I'm with Backers Network, Inc.
Justin is for the benefit of the two listeners out there, Justin is the CEO and founder of Backers Network. All right,
so
Justin,
my mom and sister are both listening, and I don't have a. Anyways.
Yeah, they can if they want, but those are my two listeners. Your two haven't joined yet.
They haven't joined in the last.
So, ordinarily I'd ask you to introduce yourself and details of the company.
Yeah.
But I want to take a little tack on a different tack. And let's just say you and I meet in an elevator, and I notice you're wearing a Backers baseball cap and T-shirt, which is good to see. And I'm like, what is Backers? But we only have 30 seconds, Justin. So tell me in 30 seconds, describe Backers.
In a nutshell, we are a regulated equity crowdfunding portal, regulated or registered with the Ontario Securities Commission and the BC Securities Commission, so the OSC and the BCSC currently, for the registration to unfold. Essentially, we enable or facilitate private companies selling shares or equity in their business to retail or everyday investors, as little as $100 up to $2,500 per investor, and issuers or the companies can raise up to $1.5 million per year. So essentially, it's like a mini IPO, and our platform facilitates that transaction online. So we do all of the KYC, the subscription agreements, all of the regulatory requirements, the risk acknowledgements, all done digitally on the platform.
The elevator stopped on the 17th floor. Luckily, I had time.
This was the 1,000th floor.
Okay, so that you said a lot, and so now I want to give you a little more time.
What does that mean?
So let's unpack
define all of those things, right?
Yes. Well, let's say you're now in a pitch presentation, and more concise, and you have a couple more minutes. This time I have to time you because this is one of those events where you're going to pitch to an audience and venture capital, some investors, whoever. You have maybe 3 minutes. So we start now. Clock starts now. Justin, go.
So essentially, we're Canadian. We're in Canada. This is a global phenomenon that started sort of early 2000s. Essentially, it's the opening up or the allowing of the everyday retail investors. So 98% of the population. I'll give you sort of the historic. 98% of the population has been restricted from investing in early stage private companies. And on the flip side, early stage private companies have been sort of restricted or limited to only getting investments from typically high net worth angel investors, VCs typically at a later stage, or they've got their other avenues or potentially banks, which typically would say no to early stage opportunities, or sort of your secondary lenders that typically charge much higher interest and can be often toxic to partner with. So what Backers is, we are essentially a registered or regulated funding portal, as I said, in Ontario and BC, and we basically facilitate what is a new sort of phenomenon of retail investors, the everyday average person, like everyone sort of listening, to invest as little as $100 in early stage private companies, which can often be some of the most lucrative investment opportunities. Obviously, very risky, high risk, high reward, but that's kind of what we do. So we're participating in what is a sort of a new phenomenon. It launched in Canada, in Ontario specifically in 2016, with the 45108 crowdfunding exemption. It's kind of evolved to the 45110, which is the startup crowdfunding or startup crowdfunding exemption, which is kind of united across the country. So we facilitate raises under that exemption. And as I said, they can raise up to 1.5 million and investors can invest up to 2,500. On the flip side, we have sort of two parts to our business. We have obviously the funding portal, which is a key sort of component to, we call it the first mile of funding, or backing the unbacked, as we often joke about. Kind of you've got, banking the unbanked in the crypto space. We're backing the unbanked, backing the unbacked, or as in logistics, you talk about the last mile of logistics is often the most difficult. We talk about the first mile of funding. So that's kind of the one side of the business. On the other side, obviously, to get investors in this format, you have to have a community, of clients, users, followers, fans, that are around your business, that appreciate what you're doing. And so we also then have the other side of our business, Backers Connect, which is a full service support services company. So marketing agency, web and tech development services. We have also third-party partnerships with lawyers and accountants and bookkeepers that we can provide sort of that business in a box to provide the foundation so they can then go out and be successful, potentially more successful, raising capital on the Backers platform.
Just over 3 minutes, Justin. I mean, the elevator ride, you didn't do justice in the elevator ride. I think I got off on the 17th floor, but that was great. I mean, so I'll just summarize that last thing. I think it summarizes it best. First mile funding for the unbacked. Backers will back the unbacked. So that's pretty profound. And I like what you've brought into some of the, the regulatory and framework that allowed for that. And you mentioned 98%. And I think in my experience over the last 4 or 5 years, a lot of startups have a healthy list of agenda, what they want, they want to, money invested in their company. And I can't imagine, $1, $2, $3 million is going to be available for a lot of these startups. And the one thing I do remember, so the money is one, and the other is, do you have traction? Do you have, community? And you mentioned the community. So I think some very important elements. I want to deep dive now into some of those, what you've said, Justin. I want to give you a chance to go into it because, one thing that's important for people to understand is the legislation that changed to make this all possible. So maybe in your own words, there's no time limit here, Justin, but in your words, let's go deep dive a little bit into the regulatory environment that supported the Backers Network initiative.
Yeah, so I mean, globally, as I said, it's a bit of a global phenomenon. Early 2000s, in the UK, I don't know the exact names of their regulatory shift, but in the US, it was the Jobs Act, I believe in 2012 or 2013, that was brought in. And so they have a similar opportunity they call Reg CF, which has kind of led to other, Reg D, Reg A, Reg A plus, all these different sort of like opportunities, essentially opening up investments to the average person, right? So typically prior to this, not to get into historically, but you'd have publicly traded companies and then you'd have private companies that were not accessible as an investment opportunity to, as I said, 98, 99, 97, whatever percent, a very high percentage of the population. And
you're right. You should get into that because this is the crux of the whole, crowdfunding and allowing small investors to participate. Right. And you mentioned it earlier in those lucrative,
often lucrative. Risky, I mean, it's high risk. Yeah, it's high risk.
Yeah, high risk, reward. But the lucrative companies, that's a kind of a territory traditionally been reserved for high net worth individuals.
Exactly. So, I mean, obviously the regulators think it's sort of a protection of investors, and that's definitely the case in some instances where, early on you'd have, they couldn't have the necessary oversight per se. Now, obviously with the digital world that we live in, they're starting to open up that opportunity. We use the example, Facebook sort of when it was sold at the IPO, I don't know the exact amount, but if you were invested $1,000, in around 2020. So again, things have kind of up, there's been a bit of a fluctuation there in their stock prices, but roughly in about a 8-year span, you were going to see about a 7.5x return on your money. So your $1,000 will be worth 7,500, which is great, for an investment in a 7 to 10 year period. However, if you had invested that same $1,000 only a few years earlier, about 2 years earlier in around 2010, pre-IPO, that same $1,000 would be worth about $77,000. So almost a 10x return in a short period of time. Now, obviously, who knew that it was going to go to where it went? Obviously, every stage of investments, comes with different levels of risk. And obviously that the reward plays out, but as a retail or average investor, it would be illegal. It would have been illegal for you to have invested unless you were a friend or family member of, Mark Zuckerberg. It would have been illegal for you to invest in Facebook pre-IPO. And most people,
why was that? Because they weren't accredited investors?
Yeah, if you're non-accredited. So the average retail investor would legally not be allowed to, they would not be allowed to invest. The average person could not invest in Facebook. Okay. And I mean, quite frankly, Facebook at that time, the model that, exists and still kind of existed today, and you alluded to it, is, traditionally they were looking for the larger investments, one or two investors at hundreds of thousands or potentially millions of dollars. Whereas in this framework, you can now go out to thousands of people, thousands of investors, tens of thousands, hundreds, thousands, tens of thousands of investors, depending on what amount you're looking for, and really bring in your community. And so I think the value of that is almost as valuable as the money itself, in that you're building a community, you're building almost a loyal following of now customers, clients, users, fans, supporters in your community that are now invested in your business.
That some of the biggest names, not the biggest names, but they start small and they start in the local community. So just think back to you did your 2-minute presentation, and an investor asked you, I've watched, like, for example, Kevin O'Leary's Shark Tank, but there's Start Engine. He does a pitch. Five companies present, 5 minutes each. Kevin O'Leary at the end of it picks the winner, so-called winner. But those companies that are on there, they already have traction, they already have users. But the most startups that go and present in some of these pitch presentations, they've just got an idea, or they want to scale, but they've had only 2 people use it, or they've tested it and they think they're going to go to the next level. And that most of the startups or the venture capital companies say, or potential investors say, come back when you've got some traction and you've built a community and you've hit on that. Right. You've hit on that the backers allows that or provides that forum. In addition to the portal, there's a methodology behind there's a method to your madness.
Yeah, definitely. I mean, there's sort of the support services. So obviously, we're very familiar with the fact, and we use the term upsell with equity. So a lot of the times, when people come to us, and you mentioned the $3 million, I was at a conference just last week, talking to a lot of different founders and different people, and it seems funny, but everyone seems to be raising $3 million. I don't know if that's just the going number, and everyone thinks you got to be raising a certain amount, and that's kind of the early number that people throw out there. But we look at it as you need to build momentum, you need to build that community, you need to get some traction. So we use the term upsell with equity. And so one of the models, that we use is sort of more of a staged or stacked or staggered, whatever word you want to term, approach, where you're raising smaller amounts every month and on an ongoing basis over a 12, 18, 24, 36 month period. And eventually you'll get to that 3 million. But the reason people look at that 3 million and they're like, I need that 3 million, is because they need to go spend all of their time pitching their idea, hope that 1 in 100 of the VCs that they pitch says, you know what, let's go with this, and gives them a few 100,000 or a few million. And then they get a bit of a runway, and then they run with that for that, depending on how much they get, they run with that for that period of time. The model that we're looking at is, let's go out today at today's valuation, let's raise a smaller amount, get a few people interested, and we call it upsell with equity. Instead of going out and saying, hey, do you want to invest in my business or invest in my idea or product or service or whatever it is, go out and just pitch your idea, pitch your product, pitch your service, pitch the idea to a smaller group of people. Start to have that conversation with people, start to get some feedback and get some market approval, if you will, market acceptance, and then turn around and say to those people, hey, by the way, you like what we're doing, you can see what we're doing, maybe you bought our product or service, depending on what stage you're at, you can now also invest in our business and sort of ride the wave of growth as we grow. So the advantage from obviously from a issuer or company perspective is you're now giving away less equity over a period of time, because today you're giving it away at this valuation, the next month at slightly higher valuation. And so you might raise that 3 million and give away 20 or 30% less equity, gain market traction, and really get a loyal group or loyal following of customers, clients, users that are also invested in your success. So it's a different mindset than what's traditionally, been pursued by, up until now, and I was on a conference call with some people this morning, like the majority of people are not familiar with this model. So there's definitely some education, but when you look
let's
at
go
it,
back to, because you mentioned
definitely a more appealing, I think a more appealing model than going out and kind of, pitching. And we talk about, one of the things that we talk about as well is the one that does get that 3 million, that's probably 1 in 100. The other 99 that don't get it, maybe they start, maybe they figure it out and they go through and they bootstrap and they do other things. This could definitely complement that or be their main source of funding. The ones that's the 100 that actually start the business. I mean, we don't know the statistics. I don't think anyone does, but of the 100 that actually start, I believe there's probably 900 that never start, right? And I think there's a reason they don't start, and that's because they float the idea around. They realize that there's so many sort of insurmountable, often, especially for various founder types or founder groups, people of color, female, all these different sort of underserviced markets. So we think that there's 900 that didn't even start because they were not given that opportunity. And that's really the 1 in 1,000 gets that 3 million. The other 999 are left kind of to fend for themselves. And that is those are the unbacked, right? And that's why we talk about backing the unbacked.
Well, let's go, because I want to close the loop on that, because you touched on I think you've called it issuers. I don't know if you said that, but the issuers,
the ones
so
issuing the shares, right?
But let's close the loop on the regulatory, because you've mentioned earlier in the 3-minute speech the regulatory. What's the framework? So let's summarize that. What is the regulation in terms of investment, the amount that can be invested, and the time frame, and the total amount, and things like that?
Yeah. So in Canada specifically, there's the 45-110 startup crowdfunding exemption. Essentially, private companies, so private incorporated companies, can raise up to $1.5 million per year. And they can, and that can be done, as I said, broken up over a series of raises. So it doesn't have to be done in one raise. And that can be, that is from retail investors. So everyday people can invest up to $2,500 on our platform. Currently is
so the maximum one person. Is it a person or a business or
person or
individual?
business, or individual or business, either or, can invest up to $2,500. Currently on our platform, we also our lower limit is 100, which also is slowly sort of through our own capabilities decreasing. So we hope to get it down to as little as $10 somebody can invest in an early stage company. So, it really makes it accessible to everyone, to literally anyone. If you can afford, a few cups of coffee, a day or whatever, you could probably invest, in a startup, and the opportunity, to be in on the ground floor with a, potential unicorn that, maybe turns to, 1,000x, right? That's the opportunity.
So it's interesting, because there are plenty of people out there, the non-accredited investors, and I hear all the time, "Oh, I'm an investor in this startup, and it's whatever, some mom and pa restaurant or mom and pa." Like, is that legal, or is it technically gray matter? There's a gray line there for some of this. I don't want to, you don't have to speak to this, Justin, but I mean, in theory, that 3 million, that ticket, the guy you mentioned, or the guy or girl that you mentioned have a business, that 3 million, it's going to be an accredited investor who picks that ticket up, or not.
100%. So it's, I mean, in that case, it's probably an angel investor. So they would typically be an accredited investor, high net worth individual, or some sort of VC, venture capital, or some sort of fund that's investing in that business. Typically, if so the traditional model, you're not going to have, unless it's a family member or someone, a close
but so
relative.
Is it legal?
So
but
they're
not accredited. Is it legal?
So they can put money into a business as a close family friend. You can, and it's usually, and again, this is the gray area. It's usually more of like I'll lend you some money, we'll see where it goes, because they're wealthy. It's not as structured necessarily, or maybe they come in as some sort of silent partner. So it's almost like they're a silent partner in the business where they give some money and they get a chunk of equity as a silent partner. So that's always been available, always will. But what this does is this now solidifies what that relationship is. And it also expands that exponentially, because that's only a few. Like if you have, Daddy Warbucks, or, you've got your, rich uncle, right, that can sort of float you a $1 million check or $100,000 check, that's fine. But if you want to go out and promote your investment opportunity to, the person down the street or somebody you don't know, like the general broader community, you cannot do that unless you go through a funding portal like Backers.
Okay. Well, let's move on then. So we've covered the regulatory framework and backing the unbacked, but let's go into the introduction of the platform to the issuers. Like, what is an issuer? And let's start with that, and just anything around your issuers or the potential businesses that will list on Backers or work with Backers.
Yeah, so I think a lot of people ask, what type of company, I get the question a lot, like what types of companies do you see? So we've been doing this for a few years. We've kind of gone through a couple different raises. We've facilitated a few. We've done some beta testing and had a lot of traction, if you will. We keep using that word. We've probably had about 2,500 companies at this point over the past 3 years express interest. Traditionally, or traditionally is a bad word. Typically, a company that is suitable for this type of investment is somebody, I simply say, if you need customers or you need more clients or you need more users, whatever you call your customer, or more fans, so sports teams is a great, this is kind of how I got into it, looking to fund a 3-on-3 pro hockey league. And the teams in it. So if you need more of those to be successful, and you need to grow a community of individuals that would potentially buy or use your service, buy your product, use your service, participate, whatever that is, then this is the model for you. So that pretty much covers most businesses, right?
It's pretty much,
it's a wide net. There's definitely other use cases. Like real estate's definitely something that's that definitely people have gravitated towards in this space, and that's slightly different. That's more of like people see the value of investing in real estate, and maybe they don't have the funds to go and buy a property outright. So being able to kind of consolidate with a group of people, this is definitely a fit. I saw an interesting thing where people talk about sort of specific, like niche, kind of like B2B type businesses where you don't need to expand your kind of user or customer base as much, and maybe it's a more technical, difficult thing to understand.
Right.
Maybe that might not fit. I talked to somebody once. They were essentially, they had one customer, which was, I think it was the provincial government. So to them, it's really not. There's no real value necessarily in that, other than maybe dispersing.
As an accountant, the economic dependence on one customer, you lose that customer.
Well, exactly. But the other flip side too is, and I was going to say to that, that's definitely true, but also just dispersing the risk among multiple people. So maybe if it's a community of those types of endeavors coming together to create or grow a bigger version of that could then sell to that entity and not be solely reliant on one or two individuals footing the bill. So that's definitely an area. I think on the sort of flip side, you've got sort of retail or things of that nature where it's very sort of appealing. But I think one of the things too that a lot of people talk about too is having like buzzworthy or sort of newsworthy new technologies and things of that nature, where people can come in and say, hey, you know what, we had a company on the platform, they were into synthetic biology, right? So FCSB. Right. And so, sort of a cutting edge technology, new wave. There's a lot of people studying it, a lot of interest in sort of at the grassroots. It's, typically, it's very hard to get one investor to kind of understand that has that large chunk of money, but there's probably a lot of people in that industry or in that space that understand it, that aren't able to cut the $100,000 checks or the $1 million checks, but we're more than glad to cut 1,000, 2,000, 2,500, and depending on sort of things, you can start to get up into slightly higher numbers, but they'd be happy to cut that $1,000 check to see that grow. And I think the cool thing about this too is that a lot of people don't touch on is, and this is, I guess, family friendly, so I won't say it, but we have a term we say about, bleep investors, what you really need are backers. And the meaning behind that is traditionally an investor, you go out, you pitch them, you meet with them for a couple hours, over a few weeks, maybe they do their due diligence. They're really trying to gauge, what is the likelihood of your business 10xing or 100xing, right?
Yeah.
And that's pretty much, I mean, if they can't see that, they're not going to invest. And I think a lot of times, not every business is set up to be the 100x, the 1000x. There's local businesses as well that service a community, service a niche, that have a lot of value and provide a lot of value to a lot of people. And maybe they're not going to 10x, maybe 100x, maybe they 1 or 2x, but it's about helping those companies get off the ground, get started, get to a position where they can be profitable, and feeling good that you are a part of that success story in your community and being a backer of that kind of success story. So that's kind of really where I think, I touched on a couple different types of companies, but those are a few of the ones sort of.
But there's just to give, to give you an idea, and I want to give some statistics, and just because I knew I was going to talk to you about this, I went and did a deep dive into some Canadian statistics.
Okay.
Statistics. So TAM, or total addressable market in Canada,
3 million
for small business. Well, okay, so I'll go through that. 3 million hits the top one. So according to StatsCan, in 2021, June, so just a year ago, there were 1.3 million employer businesses in Canada, and 3 million, or 2.961, non-employer businesses with annual revenues greater than $30,000. So that 3 million is basically non-employer, meaning that's the mom and pop shops, or the.
It was closer to 4 million in those stats.
Okay.
We looked at sort of 2020 stats previously. I think it was like 1.1 employer and just over 2 non-employer, which roughly 3, but it sounds like you're closer to 3.6, 3.8 there, right? So, which is interesting. In a 2-year span, right?
You've got 2, so I guess 2 together. So the employer businesses, which is probably 15 or more employees, and non-employer.
One employer.
Oh, is that what it is? Okay.
One employee, yeah.
So the non-employer is just one individual who's got their own business.
Yeah, solopreneur kind of thing.
Okay, solopreneur. So that's 5 million together, roughly 5, 3 plus
4 million.
4 million, 4.5.
Yeah.
But so as Stats Canada says, they're identified as active on the business register. And so it's not like, as you said, there's 9, probably from the 5 million or 4 million, there's probably another 2 or 3 million or million that just never get off the ground. They never get active.
I'd say there's probably 10 times that. There's probably, and now here's the thing, of those 4 million, I would say, roughly half of them are probably active. I mean, they're probably active on the registry. Doesn't mean they're actually active. So, I mean, we look at a TAM of probably around 1 million, 1.2, 1.5 of, functioning, actually viable businesses that, or ideas that are they're existing. And as we discussed, there's probably another million or more that are ideas in people's heads that, are definitely, that need to be fostered to get success, to become a success. I use the analogy, and I'll throw this out there because I like it. It's, the question is sort of, who was the greatest hockey player to ever live? As Canadians, we eat, breathe, sleep hockey often. And the answer, it's a rhetorical question. Most people say like Gretzky, Gordie Howe. Depending on your age, Sidney Crosby, whatever, Connor McDavid, whatever it is. The real answer is no one really knows. And the reason for that is, to play hockey, you have to, come from a cold country, so Canada or, whatever it is. You have to have, obviously have grown up in that community. You have to have access to rinks. You have to have the, typically wealthy parents to get you all the equipment, get you to the rink. You have to have gone through
hockey school,
all those different
training,
things, right?
Power skating,
everything, right? So the real answer is nobody knows, because the greatest hockey player to ever live likely never played hockey, because they never had that opportunity, right? So you look at the same thing entrepreneurship or innovations, if you will. The greatest innovation or the greatest entrepreneur likely never was, because they never had the opportunity. And so that's really where we see backers fitting in, is the greatest innovations. And our vision is that innovation will change the world for the better. And our mission is to facilitate innovation and innovators, right? So that's really, I think if you kind of, a lot of what I've talked about, it's really about providing an opportunity, right? And investing in those opportunities for those individuals to succeed and to flourish, and those ideas and those innovations to really succeed and flourish.
I just want to go, for the benefit of the two listeners out there, because I had done the statistics in case we're, the total addressable market, everyone has participated in hockey. Mr. Gretzky, because I'm from Calgary. So anything to do with Edmonton, we ignored it. Right? I just want to share this with the four listeners now.
Is it okay that I'm somewhat of an Oilers fan?
Yeah. So anyway, so back in the day
on the Calgary Business Podcast.
Yeah, we're on the Calgary. So you can be. I lived in Edmonton for 3 years.
I can be. How about a Canucks? The Canucks. No, I joke. My wife's from Vancouver, so Vancouver,
it's incredible.
Canucks,
no, okay.
Edmonton Oilers.
Yeah, no. We look. Put all that aside, because I hated Edmonton growing up. Right, 86, 87, 88, when they were winning all the cups.
Yeah.
But as I looked, I did this deep dive for, it was called open spaces, finding the open spaces. So that term.
Yeah.
And in business, finding,
like
what
the green ocean or whatever, blue ocean.
What's out there? No, but it's like, if you think of little soccer players, right? Your boys are, I think your boy or your daughter, they play soccer, right? And everybody follows the ball around. They're just like the minions, right? They're just huddled around the ball.
Yeah.
But Gretzky would go to the open spaces, right?
Right.
So literally, to find the open spaces in 81-82 season, he tallied 92 goals. An NGL record still hasn't been broken. 92 goals. Some people barely get that in both. 120 assists and then a record of 163 assists. So that was in 81-82. In 85-86, he had 212 points and 163 assists. So in comparison, nobody has beaten his assists. Nobody has matched in points. They've not even matched his assists in the last 15, 20, 30 years.
Well, here, I mean, yeah. So obviously the great one, right? But I mean, just if we're going to go down that route, the greatest family, or the most points scored by a family, like a siblings, if you will. Which family do you think it would be?
Sutters?
It's a trick question. So it's actually the Gretzkys, right? So it's Wayne Gretzky and his brother
Keith,
Brad or Keith or whatever. Yeah, exactly. Keith, yeah. I don't know which one. They played for maybe 4 games and got 1 point, but that's the greatest family scoring. Right. Anyways, let's leave it at that. The one thing, yeah. So
that TAM is going to keep you busy with. You've mentioned 1 million. There's statistically 4 million companies or potential out there for you. That's going to keep you busy. So what? Why are these employer businesses? Why do they need the backers platform? Because you've touched on it, but let's be clear. Why do they need the backers platform? This is really.
So, I mean, I think there's obviously a lot of reasons. One is, the value of being able to get off the ground, having the capital to do what you need and pursue the vision that you have as an entrepreneur. And oftentimes, I think a lot of, and again, I was at this conference a week or last week, and thousands, probably 1,200 entrepreneurs and startups there. And I think one of the things that a lot of entrepreneurs and a lot of founders struggle with is really so they have a vision, they have an idea. Usually it's related to a problem or some sort of issue that they've encountered themselves, and they're trying to address that and come up with a solution. A lot of times, and I find this. A lot of times they're unable to either articulate what it is that they're trying to accomplish, or they don't necessarily have the market knowledge to understand that maybe there's other people doing something similar, or to understand the breadth or depth of that potential of that business, right? So I think a lot of founders, what they'll do is they'll spend a lot of time building something that they think is really valuable, only to find out that
The market.
crickets, right? We were joking,
Yeah.
the two listeners, right? There's only two people that will really want to purchase it, right? So I think in a model like this, where you're able to actually, like, throughout the process, you're constantly getting this market validation, you're constantly getting this feedback, and you're constantly
Right.
refining your message, and you're constantly kind of building and growing that community, and they're, likely giving you feedback as to what you need to be doing. I think that's huge. I think market validation, I've looked at statistics, the number one reasons why businesses fail, and market validation is very high up there in why businesses fail, and it's tied into a number of different things, right? So product market fit, things like timing, there's a lot to do with timing. So you've got when you come out with something, or sort of the appetite of the general public. So
That's right.
If you look at something like, I would argue, the Palm Pilot, for example, right? You look at when they came out with that, people didn't really see the value. People weren't even really using cell phones all that much. It was sort of like, and they were trying to get this PDA, and and so it
was brilliant, right? The technology was brilliant.
The technology was
you
brilliant.
could write a letter, and it
Yeah.
predicted the
But
letter.
but there was the internet was slow, so you couldn't send it to anybody. That, like, there was really, like, just timing wise in the market. But then when you get sort of Apple and the iPhone, and sort of when smartphones kind of came out, all of a sudden now the internet has improved tremendously. You've got obviously people are using cell phones more. Everyone had one, right? It was sort of proliferated into whatever you want to call it, the general public, right? And so now you come out with this opportunity to kind of combine the two, and that's that was time.
Well, that was
right?
Web 1. Palm Pilot was probably Web 2, but they weren't Web 2.
But they were probably pre-Web 1, or like mid-Web 1, right? So that's the idea, right? So timing, market fit, market validation, those are all key concepts that people need to understand when they're coming to market with certain ideas and certain products. The other aspect is, from a business. So obviously we provide that ability to get out there, get that market validation. I think obviously the loyalty aspect's huge. The ability to garner loyalty from your community by tying them in as investors, not just sort of customers, clients, users, fans. And then the third one, which we haven't talked about yet, and I'll bring it up, is we tokenize the assets. So we are literally, I think it's somewhat groundbreaking. We've been working on this for 4 or 5 years. We tokenize the assets. We put the assets on the blockchain. So you literally are holding, your share registry is now on the blockchain. And so that, in and of itself is great. There's the transferability, the immutability, the transparency. So, kind of the transferability isn't quite there yet. You can't trade these tokens just yet, but we are working through.
But this is important
through a regulatory process. But liquidity is huge, right? So that transparency and some of those. But go ahead, you can ask some questions.
No, but let's look at that, because the reason I talk about Web 1 and Web 2. So Web 1 was just the internet. Web 2 was kind of this putting applications, the Airbnb, the Uber, that got onto web. That was kind of the Web 2.0 era. Web 3, which you've now touched on, is basically blockchain and getting, this cryptocurrencies, which really became 2017, 2018. For you, and let's be clear, for you, it wasn't just a fad. Even today, as we speak today, blockchain and crypto is kind of taking a hit. But you've gone a little bit further on the Backers platform. You've mentioned what you're going to plan on for issuers, but you yourself. Let's talk about that. Let's go right down. What have you done, Justin? That's, I think, is really pivotal.
Yeah. So, I mean, in 2017, so we identified the equity crowdfunding opportunity sort of 2015. The rules, the regulations came to be in 2016. Actually had a bit of a false start. 2016 incorporated a business to run a portal, and sort of just saw the technology that existed in sort of 2016, 2017, traditional sort of, I'd call them legacy type software, just was very cumbersome, costly, not efficient for something like this for the masses. And so it wasn't until 2017, sort of 2018, I came across, I'm familiar with Bitcoin, but started understanding more the blockchain aspect of Bitcoin and the underlying distributed ledger technology, or DLT, and how that can be used as I said, for more transparent, immutable, which means can't be changed. So no more cooking the books, to put it lightly. So transparent, so people could see all the transactions. Immutable, so you can't change or alter or deviate from what had transpired. Obviously, you've got the trustlessness, between sort of no middleman between a transaction between two unknown individuals, and then you've got the tradability, right? So the ability to interchange those and trade them amongst one another, right? And so I saw that, and what ended up happening was, obviously Ethereum was brought out, I think in 2014, 2015. We started to see the smart contracts. So essentially what they did was Ethereum took the Bitcoin blockchain concept and built their own blockchain. But what they did was they added smart contracts. And essentially what a smart contract does is essentially it's arguably a piece of code that dictates the terms, or you can start to manipulate the coin and
sort of
add rules.
What if? That's a what
rules,
if.
Yeah, it's the if-then statements, right?
Yeah.
And you can start to add rules around the coin, who can hold it, where they can be held, what they can do, what they can't do. I mean, NFTs are an example of that. Non-fungible tokens is an example of a smart contract. This, I think it's 713 or 703 or whatever it is.
721. ERC
721. Sorry, ERC 721. I should know that. Exactly. The 1404 is the security token, initial security token protocol. But anyways, 721 NFTs was one. 1404 is the security tokens. Essentially what it does is it creates a rule around that token. So if an NFT is non-fungible, it means it's unique, meaning it's non-fungible.
But your tokens, you've written your tokens under. So let's get
we wrote ERC 20 compatible. 1404 was sort of the premise that we used. We kind of built off of that. So we built the first tokenizer in late 2018, early 2019. And we were able to build those out. We are still using a similar smart contract. It's evolved over the past couple of years, but essentially what it does is it makes it regulatorily compliant from a holding standpoint.
So your shareholders today you've issued them tokens, or they're issued tokens, and you mentioned, I think you mentioned offline that they're issued or going to be issued. So do they get into their wallet, or you're still the custodial of that?
Yeah. So with our current tokens, the way it's structured is they are currently the share registry is still currently with their lawyers, if you will. So our share registry is currently with the lawyer. However, we now are able to tie the token to that share registry and have it represented on the blockchain. Eventually what will happen is, in this, there's a regulatory, kind of structure, and we'll be
like digital signatures, like accept the lawyers, the courts accepting digital signatures. Eventually it'll just be. So eventually, as we work with the regulators, the share registry will no longer be housed. I don't think it's paper based anymore, but used to be, literally like in a filing cabinet in your lawyer's office. Now it's probably digitally on their server, but that will literally be now transported. That will literally be completely housed on the blockchain. And so your legal share registry will be on the blockchain. So now you have, your assets on the blockchain. And the value of that is that they're easily transferable. So let's say you want to sell your business, you can easily transfer those to somebody else for that transaction. The next step in our evolution would be to allow for secondary trading amongst individuals, which would then facilitate essentially, an open market for private equity, whether that remains private or they would have to potentially go public. That's kind of there's definitely some regulatory things that we're going to work on over the next 12, 18 months, 6, 12, 18 months. But right now we're able to host these tokens that represent the share registry currently with the legal or lawyer's office. And then eventually migrate that where it's completely housed on the blockchain, which then next would allow for secondary trading or the ease of sale or transferability of a sale of a company. As Web3 evolves, and I know we're getting a little off topic, but bridging and having the bridging protocol so that multiple chains and that multiple exchanges as well to bridge it over. And so back to your private equity discussion, recently this week, you probably heard BlackRock formed a partnership with Coinbase. And BlackRock is a, I don't know, 20 trillion private equity fund, the largest in the world. So, this thing's not far off, Justin. It's just they're up there in the clouds, and we're down here in the guts, or what is it called, the gutter.
Exactly. Hopefully we're not in the gutter. But just to that point though, so
I don't mean the gutter, but I mean we're at the ground level.
We're at the ground level. But here's the thing though. I think one of the things, I talked about this in 2017, 2018, and all the way through, is that I think most things will be tokenized on the blockchain. Most assets we talk about, deeds to a house, or IDs, or different things of that nature, or your various components of your life, and will be on the blockchain. The flip side, and a lot of people get worried about this, and I have some skepticism about it as well. And people talk about kind of having everything AI and blockchain. The Web3 really, to me, is actually the ability to take back your personalization or personal identity on the blockchain. So now you can, they call it sort of like blind signing, where you've been validated as on this side, but you don't have to disclose who you are, what you like, to everyone. So you can choose what you disclose, what you don't disclose. And so your current, sort of real world identity is now as private on the blockchain as it would be in the real world. And so I think that's something that people are not, it's hard to grasp how that will work. And even people in the industry are, a lot of people are sort of, they're building different things. I saw some of the layer 2 blockchains are building sort of these kind of like ID privacy. I'll throw one out there, Oasis Network, or Rose is the token. They're building sort of this like privacy blockchain. So there's a lot of things out there that, a lot of people are skeptical about. But, as with anything early technology, everyone's afraid. But as you start to evolve and you start to see, the internet, people were afraid of the internet. I'll be honest, I was a little young to really be in the business world. I was sort of late high school and university to really understand what was happening, or the transition. But from my understanding, a lot of people were afraid that it was going to
it was
change.
A fad. It was
right. Well, they were, not only were they afraid, in what I'm getting at, but they were also, like you said, a lot of people were uncertain. A lot of people were skeptical, extremely skeptical, that it was going to come and go, and within years, a few years, it would go by the wayside. I joke that the biggest sort of, I guess, mental sort of hurdle for me was I couldn't grasp what a blog was. Early sort of late high school, in the late 90s, mid 90s, right? I couldn't grasp what a blog was. That was it somebody, how were they putting it on the internet? Where, and it wasn't until a few years later, I'm like, so simple of a concept now when you look at it, but in sort of the mid 90s, right? Early, I guess, mid to late 90s, trying to understand how was somebody getting that to the internet? How was somebody else getting that and understanding it on the internet? Was like from late teenager, right?
Well, it's like Jetsons, right? or if you take Star Trek and the teleportation, and so it's
right.
Literally, these things take
you need hard to understand when you don't have context to put things into. And so I think a lot of people, a lot of this stuff scares people. So one of the things that we're doing, obviously, is there's a lot of education involved. The token is on our blockchain, or is on the blockchain. It is held in our environment. So we do hold all of the keys in that regard. It is tied to the share registry currently that would be in their law office. So it's tied to it. It's more of a visual or digital representation at this point. In the long term, we hope that fully migrates over. That's something we'll have to work with the regulators.
We'll talk on but that wallet where they hold it and so forth. So look, we've talked, let's just summarize so we can, for the benefit of the 6 listeners, I saw the 2 more people joined on. But so you talked about the blockchain. You've introduced the Backers platform. You talked about the regulatory changes that made that possible, the Backers platform possible. You did talk, the main beneficiaries of the platform would be the issuers and the 4 or 5 million, but you're going to be small and focus on $1 million, which will keep you busy.
Well, I think there's definitely a sweet spot, right? I mean, not every business
Sure.
currently out of the gate is, I mean, I think every business it's applicable, you know, just even if you just tokenize your assets, you're not raising capital, just to have it on the blockchain transferability. If somebody says, hey, I would like to purchase it, it makes it very easy for you to transfer ownership over to, you know, someone quite easily. But yeah, the addressable.
Well, look, I just
market's
shared with
always-
you yesterday. I shared with you on Instagram, on UBC Ventures Lab.
Mhm.
They have, I guess it's an incubator of sorts, and 10 graduates. They announced it on, and I'll just, so the venture, not to call them out, it's just, it's called Hatch Venture Building, right down the road.
Yeah.
You're in Vancouver right now.
Yeah.
10 graduates, congratulations. And they named the 10, you know, potentially they're going to now, we've graduated from an accelerator, and we're, you know, whatever they've learned, all they need to do about fundraising, the marketing and accounting and business and building the community. And they're going to come out and they're going to need to raise. So Justin, I think you've got some work to do. Those 10, I need you by the weekend, you're going to reach out to all 10 of them, and maybe get 2 on the platform.
Perfect. Yes. So let's shout out to the Hatch program. I'm not familiar with it overly, but you did send that on Instagram, so we'll take a look at them. But we definitely work with a lot of different organizations like that. You know, we've got a pretty strong advisory board of 8 or 9 people that have, you know, a range of capabilities, from accountants to, you know, professors in universities, to, you know, legal lawyers, you know, marketing experts,
Sure.
people in wide range. So, you know, we definitely have our tentacles in certain things. We're starting to work. I know I was talking with one of our advisors, Ken, from Queen's University, talking about some of their entrepreneurship programs and sort of getting in with them. So there's definitely a lot of especially, you know, with COVID and sort of people, you know, I was talking to a lady today, lost her, you know, was laid off. And so she started a business. Another gentleman talking to him a couple of days ago, you know, kind of out of necessity, they've started businesses. But you've seen this run up of sort of entrepreneurship over the past probably 10 plus years, where people, you know, maybe it was the 08, 09 kind of, you know, housing crisis, and, you know, that sort of forced people to look at what they're doing and what they really want to do with their lives. And the fact that, you know, online, you can pretty much do anything. I mean, you mentioned I'm in Vancouver right now. I run backers remotely, right? I mean, our office is based in Toronto. We have people in Calgary, Edmonton, Toronto. We've had, you know, globally developers all over the world, you know, and so it's really, you know, the world has opened up. Opportunities have opened up, and so people can really create a business out of pretty much anywhere, build that business and be quite successful. And, you know, it's now the ability to go out and build that community online or in person, and then tap into that community and have them invest. And I'll touch on one other thing that I know you'll not bring up, because it's sort of out there a little bit. But this concept of a DAO, or decentralized autonomous organization, I see a lot of, I don't think all businesses will go this way, but I definitely think there's value in exploring how that works. And essentially what that means is that the governance and guidance of an organization is by the people, or by some sort of consensus mechanism, not necessarily a mass rules all type thing, but there's other consensus mechanisms out there. But essentially what you're doing is you're giving the power, giving the control, giving the reward, right, of the profit of the business to the people that are involved or participating in that business. So we're the first step, I think, towards
But it's not
that.
far away. That's
Yeah,
that what
that's
you just
probably-
described
Yeah.
is not far away from the crowdfunding, to allow the more people to participate.
That's the
in early stage.
democratization of
Yeah.
capital,
But
right?
we can bring up the DAOs, the decentralized autonomous organizations, and another, like, that's next. I think, Justin, that's next.
That's a discussion
But,
for podcast
today,
number 2.
for today,
episode
yeah,
number 2.
I think our listeners are overwhelmed, and I am as well. So, but let's leave the last thought first. So this is the backers. I've got that last thought here for first mile funding for the unbacked.
Yeah.
Backers will back the unbacked. Justin,
Yeah,
thanks
I don't know if we'll back them. I just want to be clear. We don't actually back anyone. We are simply the conduit. We can support them in getting them to grow their community, but it's
we're
really,
there for the
we're
unbacked.
the conduit. Yeah, we're
Yeah.
the conduit, and we're facilitating the backing of the unbacked. And we are, as you said, the first mile of funding.
Justin, thanks for joining us today, and have a great day.
Appreciate it.
Stay safe.
Awesome. Alan, thank you very much for having me. Appreciate it. Enjoy your time in Calgary. Go Flames, go. Although they just got gutted, but anyways, we'll talk about that on another
The 3HL. That's the 3HL podcast.
3HL conversation. All right. Talk to you later. Bye.